Are small cap stocks still worth your money after their recent big run? Or have you missed the boat? Today, we're breaking down what's really happening with small caps, what makes some of them high quality, and how you can spot the winners, even after a rally. Let's cut straight to the chase. Small cap stocks, those are companies with a market cap between about 300 million and 2 billion, have exploded in recent months. Investors who got in early are smiling, but a lot of people are now asking, is there still upside or is it too late to join the party? Here's what you need to know. Not all small cap stocks are created equal. Historically, the small cap universe is a mixed bag. Some companies are scrappy innovators on the cusp of greatness. Others are risky bets with shaky finances. That's why, even though small caps as a group have rallied, the smartest investors are now looking for something more specific: high-quality small caps. So, what actually defines high quality in this space? Experts look for a few key traits. First, a strong balance sheet, meaning the company isn't drowning in debt. Second, stable and growing earnings. Third, a competitive edge, like a unique product or service, or maybe a loyal customer base. And finally, good management, leaders who know how to steer the company through both good times and bad. Here's an eye-opening stat. Over the long run, high-quality small-cap stocks have outperformed their lower-quality peers by a wide margin. According to research from S&P, the top tier of small caps measured by profitability, financial health, and earnings consistency beat the average Russell 2000 stock by nearly 4% per year over the past decade. That might not sound huge, but compounded over 10 years, it's a game changer. Now, you might be thinking, but haven't small caps already soared? Isn't all the good news priced in? Great question. Yes, small caps had a big run, especially after lagging behind mega-cap tech giants for most of the past 2 years. But here's the twist. Even after this rally, many small cap stocks are still trading at historically low valuations compared to large caps. In fact, analysts from Bank of America just pointed out that the price-to-earnings ratio for small caps is about 13 compared to 21 for large caps. That's a significant discount. It means investors are still somewhat cautious about smaller companies, maybe because of recession fears, rising interest rates, or just plain old risk aversion. But here's where quality makes all the difference. During periods of economic uncertainty, high-quality small caps tend to hold up better. They have the financial strength to weather storms, and they can take market share when weaker competitors stumble. Let's put this in context. Think back to the aftermath of the 2008 financial crisis. Small caps got hammered in the sell-off, but high-quality names bounced back faster and posted stronger returns in the recovery. The same pattern played out after the COVID crash in 2020. Now, let's talk about those 12 companies experts are flagging as today's standouts. While we can't cover every name in depth, here's the common thread. They're profitable, they're growing, and they have solid balance sheets. Some are in tech, others in healthcare, industrials, or consumer goods. This diversity is key. It means you're not betting on one sector, but on the overall resilience and adaptability of small, well-run businesses. Here's an example. Take a company like Eagle Materials, a building products supplier with strong cash flow and a track record of smart expansion. Or look at Ensign Group, a healthcare provider with steady earnings and a reputation for operational efficiency. Then there's Onto Innovation, a semiconductor equipment maker riding the wave of demand for advanced chips, but with the discipline to avoid overextending itself. What about risk? Let's be real. Small cap investing always carries more volatility than putting your money in giants like Microsoft or Apple. Smaller companies have less cushion if the economy hits a rough patch. They're also more sensitive to interest rates, since borrowing costs can eat into profits. But for patient investors willing to do their homework, high-quality small caps offer something large caps can't: the potential for outsized growth. That brings us to strategy. If you're thinking about getting into small caps now, focus on quality above all else. Don't chase the hottest ticker. Instead, look for consistent earnings, solid management teams, and a clear competitive moat. Diversify across several names instead of going all in on one. And if you're not comfortable picking stocks yourself, consider a small cap fund that screens for quality. Remember, market timing is famously hard, even for the pros, but by focusing on quality, you tilt the odds in your favor. The data backs it up. High-quality small caps have delivered better returns and lower downside risk over time. So, should you invest in small caps after their big gains? The answer isn't a simple yes or no. It's about being selective, zeroing in on companies with real staying power. If history is any guide, the rally in high-quality small caps could still have room to run, especially as the economy stabilizes and investor confidence returns. Let me know what you think. Are you bullish or bearish on small caps right now? Drop your thoughts and questions in the comments. If you found this breakdown helpful, please hit like, subscribe, and ring the bell for more smart investing insights every week. And here's something to ponder. In every bull market, there are quiet winners that transform from small caps into tomorrow's giants. The question is, will you spot them before everyone else does?